Hello, welcome back to Corporate Finance class. And we'll be taking the fifth module and we'll talk on cost of capital and capital structure decision. And in this module, we will look into the sources of finance, which include debt, equity, and hybrid. We'll also look into weighted average cost of capital, and we'll see theories of capital structure. There we have, as an introduction, we have some key concepts that we need to quickly understand from the topic. The first is the cost of capital. And when we talk about the cost of capital, this is the minimum rate of return the company must earn on its investment to satisfy its financiers, that is the stakeholders, the debt holders, and the likes. And it's a crucial benchmark for evaluating whether a project is worth undertaking. And for the capital structure, it's actually the specific mix of debt, equity, and hybrid security the firm uses to finance its assets and operations. And the goal of capital structure is actually to find the optimal mix that minimizes the cost of capital and examine the firm's market value. We have three main sources of financing for an organization, a corporate organization, and this is debt financing, equity financing, and hybrid instrument of financing. When we talk about debt financing, it's actually fund borrowed from external parties that must be repaid typically with interest. We also have the equity financing, which deals with funds raised by selling ownership shares in company, and the hybrid financing or instrument is the security that combines both debt and equity. And this is just a brief of the definition. We will look into them one after the other. When we talk about debt financing, it's just like I said, it's fund borrowed with a contractual obligation to repay, and it comes with interest. And the features of this is that it has a fixed interest payment, and there is no ownership right for creditors. And also, it's a predestined maturity date. It has a predestined maturity date. And the advantages of debt financing is that interest expenses are tax deductible, and it's creating a tax shield that lowers the effective cost of capital. And it has limitations also. The disadvantage, that is, it increases financial risk, as obligation must be met regardless of profitability, whether the company is or business is profitable or not. They must meet the obligation that has been made, which can lead to bankruptcy if the firm is too highly leveraged. And for the equity financing, it's raising capital by issuing ownership shares. And for this, the features are that it represents an ownership interest with voting right, and dividend are not obligatory. And lastly, the equity is a permanent source of capital with no repayment obligation. So it's the use of shares to be able to finance an organization, the selling of shares to be able to finance an organization or to be able to finance a project or that is to be done by such an organization. And an advantage of this is that it does not require fixed payment, providing financial flexibility during downturns. Maybe when the corporate organization is running at a loss, it creates a flexibility, like it makes the financial repayment flexible, and it does not, as against the debt financing that is obligated. This is not having an obligation, and it has its limitation. Generally more expensive. It's generally more expensive than debt due to higher risk for investors and a lack of tax deductibility for dividend. So I said that the hybrid one is the combination of both the debt financing and the equity financing. So there is no more explanation, but it's actually in the notes. So that's just a brief of it. And we move to the weighted average cost of capital, the WACC. This is a calculation of a firm's average cost of all its sources of capital weighted by their respective proportion in the capital structure. And why does this matter? Why it matters is it serves as a single hurdle rate for evaluating new project. And if a project expected return is greater than the WACC, it should be accepted as it will create value for shareholders. And if the return is less, the project will actually or should be rejected as such. Now, in calculating the WACC, it's actually the E, which is the market value of equity divided by V, which is the total value of the firm, multiplied by R, which is the cost of equity plus open bracket, the market value of debt divided by total value of the firm, and multiplied by the cost of debt multiplied by open bracket 1 minus corporate tax rate. This is the formula to be able to calculate the WACC, and we have the examples in the notes as such. Now moving to the last aspect of our lesson for this module, which is the capital structure theories. We have a number of theories, and for this we are talking about 3. And the first is the M&M proposition. In a perfect world without a tax or financial distress cost, a firm value is independent of its capital structure. And this is what M&M proposition actually focuses on, that in a perfect world without taxes or financial distress costs, a firm's value is independent of its capital structure. And that of the trade-off theory proposes that firm balance the benefit of debt. They balance the benefits of debt, that is the tax shield, against the cost of debt, which is the financial distress and bankruptcy cost, to be able to find an optimal capital structure as such. And the last theory is the pecking order theory, and this suggests that firms prefer internal financing, which is retained earnings first, then debt, and finally new equity as a last resort, as managers prefer to avoid the negative signaling of issuing new shares. And these are the 3 theories that we are talking about that actually focus on the capital structure. What is the relationship between WACC and capital structure? The first is that the cost of capital is not static. It changes as the proportion of debt and equity changes. Second, adding debt can initially lower the WACC due to the tax shield. However, at a certain point, the financial risk of too much debt outweighs the tax benefit, and the WACC begins to rise. And the optimal capital structure is a mix of debt and equity that minimizes the WACC, thereby maximizing the firm's value. In conclusion, understanding the cost of capital and capital structure is vital to any firm. The mix of debt and equity directly impacts a company's risk profile, the profitability and overall value. And by strategically managing financing decisions, managers will be able to lower their WACC and make value maximization investment decisions. And ultimately, this helps achieve the core objective of corporate finance. And what is it? Maximizing shareholders' wealth. Thank you.